why investors are selling their properties in Perth.
Yes. I haven't seen Northern Territory as a purchasing state for probably 10 years. I'm seeing a majority of the purchasing, definitely without a doubt, Victoria. New South Wales will always continue to do well.
The big dog, he's back. Good to see you, mate. You got a new glow about you.
I do. I feel revitalised. I always feel, every year I get older, I actually feel a bit younger.
You look younger, yeah, absolutely.
So no, it's been exciting. It's been a very interesting start to the 2025 calendar year. We've had a rate cut, probably anticipated by some, and maybe a little bit earlier. For other people that said maybe March, April, May, or June.
Soon enough for someone like Jack Henderson with a lot of debt. Let me tell you.
The good thing is every time there's a rate cut, when that denominator of debt that you've got, it's a material change in terms of cost.
50 grand that made me. I was stoked.
It's probably going to be a little bit more. We're definitely starting to hear the word recession creep into a lot of the economies around the world. I still feel in Australia, while they may believe that we're in a recession because we've had a number of quarters of potentially smaller or lesser GDP growth than they anticipated, I still looking out today, this morning, while before having this podcast today, there's still people out in cafes. There's still people spending money. And I think it comes off the back of
cost of living.
Your recent interview that you had in that forum there with SBS. And I'm a big believer of what you said actually is correct. I don't truly believe we've got a cost of living crisis. I believe in my heart we've got a cost of spending crisis. I think people haven't reacted and changed their spending habits with the economy that we're in, which is now higher interest rates. And yes, things have gone up, but I get to see a lot of people's incomes. And I can definitely tell you that people's incomes for most professions have doubled in the last 10 years. So if we've got property prices doubling in 10 years and we've got income doubling in 10 years, well, then it kind of nullifies each other.
What do you reckon? Because that's a big thing I see all the time, or income growth at the lowest has ever been, blah, blah, blah. There's a multitude of variations of that comment. But I mean, I'm an employer, and I can assure you, incomes have grown significantly, both what people expect and what you have to pay them, which is totally fine. And just like you said, incomes will be double. Why does that not necessarily reflect in the overall data around Australia? Is that because, I mean, I don't know. Why doesn't that reflect that? I mean, there has been some income growth, but I don't think to the level of which.
Yeah, look, it's tough, and it could be that there's a lot of new jobs, or definitely people working lesser amount of days. I have definitely seen that, but the reality is that for most professions, and we're going through from tradies all the way to professionals and service industry, even to retail workers, there's been an increase in income, no doubt about it. And that 4 years during COVID, it really did pop quite a bit. I think, costs did increase in some things a lot higher than expected, and obviously due to supply and demand restrictions. But, I look at graduate accountants, for argument's sake, who are starting 10 years ago at $35,000, $40,000, including super. You're not going to find a graduate accountant for anything less than $65,000, $70,000 today. For an employer, that graduate accountant is generally making you a loss for the first 6 months, if not 9 months, as they're really learning the ropes. So that's a steep thing for employers to absorb, these younger guys coming through, not making money for the first 6 to 9 months. And then when they do finally make money, instead of moving laterally, they move to another job, and all of a sudden they've got a $20,000, $30,000
Jeremy's trained them and off they go. They just on the launch pad.
That's it. And it's a good thing. It's a positive thing. It means I'm doing the right thing in terms of training inside my group. But that's what's happening. And I see it. I see people tax returns. I collect that data every year. There is a substantial movement in what I've seen with a lot of my clients' income, and I'm going to go out on the record and say I've seen a doubling of incomes across the board of many of my clients over the last 10 years.
There you go.
In line with property prices. So yes, property prices have increased, but there's been a genuine material change in the increase of wages.
And you're on the front line of that.
I'm on the front line.
Now, you had a YouTube video recently. Why investors are selling their properties in Perth.
Yes.
Let's unpack that, mate, because it did very, very well. And I think it's interesting to unpack. I have a very strong belief around these marketplaces that are very transient for investors. People get in when times are good and then try and get out when times are not so good. Entry costs, exit costs, and they try and find the next hotspot. And I don't know about you, but I've never actually personally met someone who's made a significant amount of money doing that. I've never met one investor where they're like, oh yeah, I just get in and out of marketplaces. I time them and
Yeah, well,
cash to the hilts.
I'm lucky enough that I have met those people.
All right,
I'm
fuck
lucky
me,
enough
yeah.
I have met those people, and they've done very well. And there's a number of clients who have purchased in the Perth market during 2020 and 21, doubled their money. I've had some clients almost triple their money.
At what scale though?
We're talking $300,000, $400,000 properties being sold at $700,000, $800,000.
But how many properties are they buying at that level?
Probably one or two.
Right.
We're not talking a lotto win. I can retire for the rest of my life. But $300,000 or $400,000 growth, less tax. Say you're losing 25%, 23.5, but we'll call it a quarter.
Yeah.
That's a lot of money for some people. Making $250,000 clear after tax in 2 or 3 years, they wouldn't be able to save that in 10. So to see that happen for people, it's exciting. It's one of those areas where I've done it as well. I bought in 2019 and 2020. I didn't expect Perth to move the way it did. I bought there because, hey, it's been on the back end for 10 years. It hasn't moved. Rental had substantially come down, started to tick back up a little bit, and yields were good. I had a 10-year plan there. I was going to be there for 10 years, wait till it doubled, and then I'll get out, because I knew WA had a higher cost of repairs and a high cost of property management, etc., and other things. From my point of view, I did sell out of 3 of the 4 that I had there. I doubled my money on 2 and almost tripled my money on 1. It was always going to be, you mentioned transient, for me, transaction-based. I was going to get in, get out when I hit a certain threshold and move that into other areas of the market, maybe for a bit of a cash flow play or further capital growth play. But on the tip of everybody's tongue at the moment, Jack, it's all about hotspots. Everyone is looking for that next Perth. Everyone's looking for that property market to double in 3 or 4 years. Sometimes you get lucky and you buy right at the start of the cycle. Sometimes you buy in the middle or at the end. Sometimes you buy in the middle of the downward cycle. You still got to treat property as a long-term strategy. If there are short-term wins, then that's great. If you do make those short-term wins, sometimes you've got to have a think about the exit. Because if you do have a period of stagnation, your 100% return in the first 2 years, say 50% per annum, starts to come down year by year.
Every year you hold it, yeah.
Every year you hold it. So nothing wrong sometimes with selling if you've got a business plan of where to put it next. But hotspots is on the tip of everybody's tongue. And what I'm seeing with my client base is they bought in these areas with 2% interest rates. They were cash flow positive. They've now seen double in effect happen within their portfolio. The property's now costing them $10,000 a year to hold, and they're not seeing that level of 22, 23% growth per year. In fact, numbers there from what I've seen, especially with clients selling, they thought there would be this rampant amount of people going through open homes. There's not. They thought that they'll be selling their property well above asking price. They're not. And agents I've spoken to, especially for the one that I've got there now, I said, what's the market like, Jeremy? It's definitely cooled down. We are not seeing the level of investor activity that we had 3 years ago.
And what was the level of investor activity? Was it majority investor driven, this growth?
Absolutely. I had 9 out of every 10 properties that I was seeing clients buy during 2020 through to 2023 being in WA. And they've done well. They haven't lost. Most of these people have still made money, even if they were to exit today after costs. But at what point, when you start to see that period of stagnation come in, do you say, well, it's time to flick it on, or do I hold it for the next cycle? Because Perth is one of those things where there are high costs, council rates, insurance.
Let's talk about that. You own
fees.
properties there. You've got properties in New South Wales. You've got properties in lots of states. What's the cost disparity between a property in New South Wales, say, to a property in Perth in terms of what's your property management fees?
Yeah, so take land. I always say take land tax out
of the
because
equation.
Land tax is variable between all different states. But property agent fees in New South Wales, I'm getting them as low as 5%, including GST, because our rents are higher.
Not with Henderson Asset Management, that's for sure.
But again, you pay for the good people. But in Perth, they've held their property management fees at 8, 9, and 10% for a number of years.
Almost double, could be double, or 50% more.
It's all well and good when rents were $300, $350 a week, but as we all know, rents in WA have doubled as well. So many people are now spending 10%, 9%, 8% on $700 worth of rent per week.
Yeah.
They've got every time, in New South Wales, for argument's sake, you'll get a property inspection being done. It's included as part of the property management service, where in WA there's a charge for it. So they do charge you for that. And then there's all these other little hidden costs that they include in, where in New South Wales or even Queensland, for argument's sake, it's all included as part of the price.
Yeah.
So there are little things like that which will represent a higher cost in WA than in New South Wales.
What about insurance, for example?
Insurance, look, generally I've seen insurance being slightly higher there
Mm-hmm.
compared to New South Wales. But again, it's variable based upon the property's condition
Yeah.
and where it's located. At
Repairs
the
and
same time.
maintenance?
Higher, much higher. Much higher, because again, we've got a lower amount of population. There's a significant trade shortage in WA compared to, well, we've got a trade shortage here in New South Wales, but I think an even higher trade shortage in WA, and costs them more.
Yeah.
You know, it's not uncommon to see a handyman charging double compared to what a handyman would charge here in New South Wales.
So your gross cash flow or your yield might seem strong, but then when you actually look at net numbers, take out your higher expenditure,
Absolutely.
the yield of 6 or 7% may not be as strong as it may seem on face value.
Correct. And typically, everyone asks me that question, Jeremy, where do you see the best net yields in the country? And I actually generally say Queensland's probably for me where I've seen the best net yields, probably followed by New South Wales to some extent. We all know Victoria is where we see the lowest net yields, but a very different market. If you invest in Victoria, you're investing maybe for that capital return as opposed to that long-term cash flow.
Yeah.
But net yields are just how good you are in terms of buying the right asset at the right price and what you do with that asset. I think that's important. A lot of people say, I want to buy something with a net 6 or net 7 yield or a gross yield of 8%. You won't find it typically, but you can buy it and you can make it happen.
That's right.
And that's what I always tell people. Don't try to chase a net yield, a high net yield. Build it. Make it happen. Force it.
We do that with our yield accelerator method, which is the granny flood or the second dwellings, right? You can literally double a rental yield with, you know, the expenditure of which the bank will fund the majority of it anyway.
Absolutely. So make it happen or build it. Don't try to buy it because people are going to be asking for a premium.
Or you're going to be buying a shit asset. And, you know, so many people are going down the boarding house route or some other horse shit asset. That's just specific for investor demand.
Well, you talk about that. The biggest thing I've seen is, people talking about the NDIS properties, buying and building the NDIS properties and getting 140 grand. I've seen some challenges now from clients who have bought it. It's taken 6, 7, 8 months to find the NDIS participant. Now,
one of them as well, because you don't get that yield unless you've got all rooms filled.
Correct. So that's been a bit of a shock because on face value, the numbers are fantastic.
That's right. Then you factor in your vacancy rate. I see that shit all the time. Hence the reason I tell people not to buy assets that are niche to one marketplace, because one, you're only going to resell it to an investor looking at it through the same lens as you're looking at it, and you're going to have a lot more issues.
Absolutely. So you want to have something that you can market to a wide range of audience.
Agreed.
But WA, coming back to the original question, definitely seen a bit of a shift, and I always say to people that the property market here in Australia is driven by the equity of the East Coast, more specifically New South Wales. If New South Wales property is doing well, if there is equity movements and equity increases here in New South Wales, where we hold the largest population, probably the largest GDP by state basis as well, all the other states will get to prosper with it or from it. And WA was genuinely a benefactor of New South Wales equity growth during that COVID boom, because I could almost guarantee you that, again, in my client base, 9 out of every 10 properties I've seen in WA weren't WA residents. They were people from the East Coast.
And it's interesting, right? Because now what happens is that we talk about long-term strategy. Obviously, buying and selling within 3, 4, 5 years is not long-term. But when all the investors start to move out of that marketplace, there's more stock that goes to market, there's less buyers for it, and then the buyers that are there are your owner-occupier buyers. Owner-occupier buyers go, fuck, I'm not paying that for it. I know 5 years ago I could bought that house for 700 grand, and then slowly the market starts to level out at where owner-occupiers see value, right?
That's it. And look,
Tassie was a good example of that.
And Tassie's been flat for the last 4 years. It had a really good run for 3 years before the COVID boom. Properties were moving substantially, and now it's definitely been flat. If anything, I think it's seen some negative quarters of growth. But, people ask all the time, well, Jeremy, what's driving these hotspots? What's driving people to all invest in one area? And it's a concentration of forums and a concentration of property professionals. A lot of people are consuming so much data that there's this herd mentality now. And it's all well and good for the people that get in early and maybe get out a bit early. But generally speaking, a large portion of that herd will get in towards the end and be left holding the stick while the few have been able to exit quite strong. So sometimes you've got to have a business plan for what you're buying. Sometimes you do get lucky and you do time the market really well. But that business plan of the exit and where you move that money into is also crucial as well.
Let's talk about that. So you said most buyers now, or most clients that you're seeing, are looking for that next Perth, the next hotspot that can make them $1 gazillion overnight. Where are people starting to look now? You're on the coal phase. I'm assuming when people are buying property, they're coming to you asking what structure they should put it in and whether they should buy there or not. We get those questions all the time. Where are you seeing now people are going, where can we make the next quick buck?
So there's still a small amount of people still buying in Queensland. I've definitely seen a movement.
Whereabouts in Queensland though?
So,
like
not the lower socioeconomic areas anymore. Right. So there was that really big, again, thrust in 2020, 21, 22 into that lower, southeast region, your Logans and, maybe in your Petrie Basins, your Deception Bays, but starting to see a bit more concentration of good quality properties. So
I've been watching my content, yes.
Yeah, things about 15 k's away from the city.
Yeah, so Strathpine and places like that.
Yeah, north and south and also west. So I think there's the people that are buying there are saying, well, we do want some quality. The people that have got lower socioeconomic properties there, they've felt the pinch of high repairs and maintenance. I was talking to a client a couple of weeks ago, Jeremy, I've made some money on this property, but my God, every week there is a repairs and maintenance to do, whether it's ovens, kitchen doors, carpets peeling, floorboards are moving. I've been living in my house for 10 years and I've spent less in 10 years on my own home repairing it than what I've spent in 1 month in this investment property. So it goes with the territory. If you're buying rundown older properties, lower socioeconomic areas where people maybe aren't taking care of it the way you would take care of your home, then you've got to expect to put your hand in your pocket to fix a lot of things or find a new tenant. So a little bit happening in Queensland, but where I'm seeing a majority of the purchasing at the moment is definitely without a doubt Victoria. 2 years ago, not one property I saw being purchased in Victoria. Now, probably 4 to 5 out of every 10 properties that I'm seeing clients buy are in Victoria.
Regional?
A mixture of regional and probably with inside 20 to 30 kilometre radius of Melbourne CBD.
Right.
And that's good. There's some of those regional areas there which have good industry.
Yeah.
And there's a lot of these metropolitan areas around the CBD, which, again, I think, even looking back, are very well priced.
I think so, yeah.
Yields aren't the best, but you're not going to Victoria to get a smashing yield. You're going there to chase a capital return. And again, it could be part of your strategy to hold long term, or you could be buying right and maybe moving that property into a more performing, more cash flow orientated property environment. And lo and behold, and I've mentioned this on my podcast, and I'm going to give it a plug, What School Should Have Taught You for anybody listening.
It's a great YouTube channel.
It's all about financial literacy, and I'm sharing with people all the things I get to learn every day. But I'm starting to see a lot of people being led by property professionals and forums buying in Northern Territory. Now, I haven't seen Northern Territory as a purchasing state for probably 10 years, maybe 9 years. And at the moment, I'm starting to see a volume there. People are buying prices, below $600,000 with very attractive yields. And I've mentioned in a recent podcast that Northern Territory only has about 255,000 people. So it's a market that if there is enough people that get in there, that herd starts to drive a lot of their wealth into Northern Territory, it can materially change that state. You could significantly reduce the supply and increase the demand very quickly. The challenge will be, again, is the sustainability of it. If it's been driven by a substantial amount of investment in that area, then yes, you could make some really short-term growth and you could see that pop that WA had, but it's the sustainability for it to achieve that in the longer term.
It's manipulated. It's not real.
It's hard to continue that.
It's not fucking real. And Darwin's a funny one. I've done videos on Darwin before, the shitholes that Jack wouldn't invest in. People should get on a plane, fly there, and then ask me if you'd ever live there before you invest there. The place is fucked.
Yeah, look, I can't comment on it. I haven't been there personally myself.
I can comment.
I can't comment on the areas, but yeah, the challenge is that if it's a very investment-led driven market, then as soon as those investors pull out, you're taking out a huge portion of demand.
Yeah, and the same thing. It goes back then to owner-occupiers and what they'll pay there, and they go, I'm not fucking paying the prices that these idiots were paying.
Yeah.
Your yields get slimmer.
Without a doubt, and I probably will challenge one of the things I hear from you quite often about you should never own your own home, right? You should be rent vesting. And I actually say in an area that you're living in, say for argument's sake in the eastern suburbs of Sydney, absolutely makes sense. I watched a video of a gentleman called Adam.
Yeah, last night I posted that.
Mate,
it's blown up.
I was watching it with a friend and he goes, Jeremy, what does that all mean? And I said, well, he's spending $55,000 a month on principal and interest. Instead, he could be spending $5,000 a week. Let's call it arguably $25,000 a month.
Yeah.
It makes sense to be renting that property. it makes sense because there's that $30,000 now surplus he has to invest in other markets. But if you're living where I am in the southwestern suburbs of Sydney, where purchase prices versus rental yields versus loan repayments, the disparity is not too much, then that ability of getting capital gain tax-free growth in the future is a good thing. And people often spend more money on their own home than they will on an investment property.
Agreed.
So they'll have
buy a better asset.
Buy a better asset, and they can sell it to an owner-occupier, which I'll lead into that later. But that means that they're getting a larger portion of capital gain tax-free wealth, which can be used at retirement or to upgrade or downgrade their home. And I see it happen quite often. But if you are an investor who is wanting that lifestyle property near the coast, near the beach, and the disparity between what you pay on a mortgage versus what you pay on a rent is huge, you rent vest.
I talk, my content, all of a sudden, now hundreds of thousands of people and sometimes millions of people that see it. But the reality is I talk to my niche. I talk to my client base. And my client base generally aren't your Australian punter spending $1 million on a home. My clients are these people in the eastern suburbs or in the best suburbs of Brisbane or wherever they are. And I see it, like we've got management consultants and fucking, partners at accounting firms and business owners who are making millions and millions of dollars a year. And I look at their cash flows and 70% of the surplus goes to an owner-occupier home. And then the funny thing is they have that home for 5 or 6 or 7 years. They do make some good money on it. But what happens then when they make more money? They don't go, oh, let's go into something smaller. They go, let's increase that mortgage. Let's get a bigger house. And it becomes incredible at the end of their life when they could potentially sell it down and downsize. But generally what happens is they fucking stay in it to the day they die. They die and the kids get it. And
there's a risk as well because you're concentrating a large portion of your wealth in one asset. So it generally makes sense. And I've got clients that reach out. I've done this calculation with a client in Mossman, wanted to live in a $10, $12 million home. And I said, mate, it's not worth it. By the time you pay the council rates, repairs and maintenance, a very old home, I said, you're better off actually renting this property, which I just went on to realestate.com. I said, it's a far better property and it's going to cost you about 70% less in terms of fixed payments. Once he did that, he actually went and rented that property straight away.
Yeah.
He's invested his money into, he's a shares man, so he's invested his money
into... Yeah, but I mean, it doesn't matter, right? It's all the same shit.
He loves it. Best decision he's ever made. He said, Jeremy, I've made so much more growth and tax-deductible growth because of the loan that he took against it, and it's been a good decision. So you got to weigh up where you're living, what your outcome wanting to be, and that disparity between.
I always say, if you're the average Australian, you're living in a home worth, 500 grand, fuck knows where you're buying for 500 these days, to $1.5 million, there generally isn't that much of a disparity to say rent vesting makes sense. And you probably don't have enough dispersible or disposable income to be able to go and invest and make a material difference. But if you look at Adam Sullivan's situation, like you just said, he spent $11 million on that house. He put in $2.5–3 million of his own capital, so it's held up there doing nothing. 55 grand a month in mortgage repayments, and to pay those mortgage repayments, he's then got to push out $1.2 odd million minimum of income to then pay that, pays 47 cents tax, and then pay the mortgage, and then do it for 25 years.
Yeah, there's a lot of
and that
wastage.
House is cool, no doubt
Beautiful
about it.
home. Beautiful.
For 6 months, 12 months, and then it becomes another house, and then one just down the street builds and it's better, and you walk past it every day and go, fuck me, that'd be nice to have a bigger one, or I'd like to be closer to the water, it takes too long to walk. Like, that's the reality of human beings.
And the upkeep, what people don't realise, a house like that, there is a lot of upkeep. We're talking tens of thousands, maybe hundreds of thousands of dollars in upkeep. So I watched it and I thought, what, great video, because it actually makes so much sense.
And he said it, like I just picked up what he said in his YouTube video, and I was like, that's a prime example of someone doing really well, probably didn't realise what he was getting himself into, got himself into that home, and I thought, he probably thought, fuck, this is no good for me.
Absolutely.
And when you're young and you're busy and you're hustling, you're not home. You're travelling. Your house is sitting vacant. Like, it's something that I realised, and I'm like, even my rental, like I spend a stupid amount of money on rent in comparison to what I could spend, and I'm never there. And I'm like, I'm spending all this money. It's a beautiful house. When I'm there, it's beautiful. But when I'm not there, it's just wasted money. I'm just pissing it up against the wall.
Absolutely. So it's about being financially literate with what you're doing and budgeting, and it comes back to one of your most recent things as well, where you said that there is a cost of spending crisis, and I think there really is. People just aren't in tune with their finances. They don't understand how to budget well, and if you're not in tune with your finances, you can't budget well, you're not going to make the right decisions.
Regardless of how much you earn. Like,
Correct.
it doesn't change whether you're earning $75,000 a year, which is the challenge I'm doing now. I'm not sure you've seen that, but I'm paying myself $75,000 a year, assuming I have none of the mortgages and stuff that I have, obviously, and saving for a house deposit within 12 months. That's my goal, 5% deposit thing. But if you don't have good financial literacy and understand your numbers at 75, when you multiply that it just gets worse.
Absolutely.
You just add zeros to your bills.
And there's a large portion of people that I meet, some very smart people as well, that just don't, they don't take enough care, and they don't understand the impact of, and coming back to a couple of the other topics we spoke about, when you're investing in hotspots or wanting to chase that next deal, sometimes it's all right to take a different approach, a low, slow approach, where there is almost a path and a trajectory you can almost map out, because life's complicated enough to try to then move and pivot every single second. Although smart people do it and do it very successfully, but if you don't have the financial acumen to do that, then that's fine. You've got to make sure you look at the right people, have the right team around you to get there, but also action. And I think that's one of the biggest key points as well.
Agreed, man. Let's go back to what we're talking about, which is off the back of your YouTube video, people moving out of Perth, investing in, shitholes that Jack would invest in, like Darwin, for example, or, I'm seeing a lot of regional stuff in regional Queensland or far north Queensland. The thing that I always see is when people make a small amount of money, they invest like this. As soon as people start to make a material amount of money in their life, they're making hundreds of thousands or millions of dollars a year, they then completely move away from that methodology, because to be able to make enough money to make it make sense, you've got to do it at a very high volume. To make 300 grand in a property in 5 or 6 years sounds good, but if you're making 500 or $1 million or $2 million a year, it's not really all that material by the time you buy it, you sell it, you fucking get back into the marketplace. So do you see a similar thing? And I even see it with these property people. They start off in that ecosystem because they're usually lower income earners. They build a portfolio. They then get into the marketplace as a buyer's agent. They start to make good money in a business, and then slowly but surely, their strategy to their clients remains the same: buy low dollar value properties, because that's how I built my wealth. But then they personally start going into high dollar value commercial properties, or high dollar value residential properties, or they go buy their dream home in a good location, and they move away from that low dollar value shithole that they sell to the punters.
All the time.
Yeah.
All the time. It's a natural progression. And the reality is you start to realise, myself, I'm followed that exact same path. I was buying very cheap, townhouses in Queensland and cheap houses in New South Wales. And then there is a light bulb moment that happens, and you start to say, well, there's a lot of contingent liabilities I'm carrying. Because again, in one of our past things, I think we spoke about this before, a $40,000 roof on a 500 grand home is a $40,000 roof on a $1.4 million home. As that denominator changes, the percentage of repairs changes drastically. So yeah, I do see it a lot, and I see it with professionals, property professionals, and clients in general. They do start off and they get a bit of a taste, and they wet the whistle, I suppose, in the sense of buying cheaper properties.
Yeah.
But all ultimately end up the same, buying more expensive properties, because they understand that the denominator is what's important. Getting that denominator built up across maybe a lesser amount of assets is going to be far better than having, say, 200 assets all worth 100,000 each, because there's a lot of kitchens, a lot of toilets, a lot of roofs, a lot of repairs and maintenance and contingent costs that are in that portfolio. So yes, you always will end up, in most cases, buying far more superior properties with a higher cost, because they do often achieve better returns in the long run, because maybe they might be more desirable to owner occupiers, more and better rents, and lower risk properties, because they're in a market where people can potentially afford
and
it.
they make money.
And they make money.
Yeah, the thing that I see, and I know from my own situation, it's like, I'm so busy in the day-to-day, and I'm assuming you're exactly the same. You're growing your business, you got staff, you got fucking shit going on here, there, and everywhere. The last thing you want to do is worry about, I'm going to go buy 5 fucking $500,000 properties this year, when you can go slap a $5 million asset and move on, I think
it's important for people to grow those legs, though. I think if you can start off with a lower risk, lower cost property initially, and again, you might be young, and a $400,000, $500,000, $600,000, $800,000 property is all that you can afford, do it. Do it. Get yourself into the market, get a taste, and be confident with taking on debt, because the more confident you are taking on debt, more acumen financially you'll be able to build up and then grow. But if you're on your 15th investment property and you're still buying $250,000 one-bedroom apartments in the middle of nowhere, I'm going to really challenge you on your investment strategy, because one would argue that you're just buying for a number, not buying for a value.
Agreed. Now, the debt recycling strategy. You've spoken a lot about debt recycling. Bruno from my team sent me, I think, one of your YouTube videos the other day. He's like, mate, you need to talk about this. I said, mate, I'll fucking talk about it with the man. You mentioned before, rent vesting is good for some. I agree. Not good for everyone. But what is good for everyone is debt recycling. Like decreasing non-deductible debt, replacing it with deductible debt and income-producing debt is a good thing. So can you just give us the 101s on debt recycling, because most people will start with their owner-occupier home. They then get a bit of growth in that home. They probably decrease the debt, and then they go, "Oh, I've got this great idea. Let's go buy an investment property." And they don't actually realize that they're debt recycling by doing that. But let's just break it down as simple as it can possibly be, so people understand the concept of debt recycling.
Beautiful.
Fancy words.
Really good way to do it. Very common scenario for many people. You've bought $1 million home. Your loan now is $500. Your loan now is $800,000.
Yep.
So you bought it with a $200,000 deposit plus some costs that you paid cash for. That property's still worth $1 million for argument's sake. Let's say it hasn't grown, but you've now built up $300,000 in your offset account over a number of years. You've saved really well. You've worked hard. You've done that. You're only paying interest on the difference of 800,000 less 300. So 500 grand is the interest you're paying. Interest you're paying on, I should say. And your repayments, though, are still on the $800,000 mortgage. A true debt recycling strategy is taking that $300,000 cash and using to pay down your $800,000 mortgage.
So not leaving it in the offset account, but actually decreasing your mortgage.
Physically decreasing your mortgage. You now go back to your mortgage broker and you say, hey, my mortgage is now $500,000.
But I don't have access to my $300,000.
But I don't have access to my $300,000 cash. I want you now to rewrite my loan for another 30 years. 5 years interest only potentially, or 30 years P&I, wherever you want to structure it. And all of a sudden that lowers substantially now your minimum monthly repayment. So there's a borrowing capacity benefit attached to it. That's action point number one. Action point number two is now I've got a property worth $1 million because it hasn't grown, but I've got a debt of $500,000. I want to now extract that $300,000 worth of cash that I put into the loan to lower it, change the way my loan is structured, and I want to have that in an interest-only environment with the corresponding cash and offset accounts. I'm still not paying interest on that 300 grand till I use it. That is a true debt recycling situation. Now you've got a 500 grand mortgage on the new minimum monthly repayment, so your cash flow's improved. You've now got your $300,000 cash back out in a separate split loan with a corresponding offset account, meaning you're not paying any interest until you use it.
So you haven't just pulled it out of your offset account and used it and then increased your non-deductible debt again. You've paid it off and you've split the loans completely.
Correct. Yep. And now you've got this $300,000 cash balance, which as you use it, you will pay interest on it, but you can now use that for deposits and cost of new properties.
Or other investments.
And that is a true debt recycling strategy. A lot of people I see, they just never get the information around it. They may be extracting equity out of their investment property first, or they might be using cash from their offset account. I'm saying, guys, let's use the money in your offset account to pay down your debt, refinance your loan. So you've now got a lower minimum monthly repayment, extended the loan term, so there's a borrowing capacity benefit in doing that, extract the equity out as a split loan, and now use that equity for more deposits. And when people start to realize that, blows your mind. And it's got to happen at a mortgage broker level, but quite often I'm seeing accountants and people like yourself and other buyers agents really coming up with that strategy. So as a client, as an individual with cash there, look at debt recycling. Look at an opportunity of reducing your non-deductible debt, now refinancing your loan, extracting it out under more investment-friendly terms, and using that money to increase your portfolio.
So it's decreasing non-deductible debt and the interest payable on that non-deductible debt, and ideally still keeping your minimum repayments at the level they were at before you decreased your mortgage, so you're paying it down faster.
You can.
Or putting it in the offset account, whatever works for you. And then using the equity as opposed to the cash in the offset to then go and invest. And essentially then what becomes tax deductible is the interest on that equity split.
Absolutely.
If it's used for an investment purpose.
Absolutely. And it's something that you don't have to do once. You can do it many times. Now, poor brokers are listening to me saying, Jeremy, don't say all this stuff, but it is important. And you don't want to do debt recycling for 10 grand. That is a waste of time. The fees of refinancing, all these other things become quite costly. But once you build up, maybe $100,000 or $150,000, that's a very material difference. We're talking $6,000 to $9,000 of potentially now newly deductible debt from an interest perspective that you can now claim on your investment property. So it's a great way to reduce tax if that's what you're doing, buying in your own name, but also give you an improved lending structure to facilitate a much better, much larger portfolio.
I have a technical question now, which probably won't land with a lot of people, but I spoke to an accountant the other day with a client on the phone, and I thought that would be a great thing to discuss on the podcast. Hypothetically speaking, we have a unit trust. The unit trust goes and purchases a property. Let's just say one individual owns all the units in the trust. Now, traditionally speaking, if the unit trust held that debt, the debt would not be tax deductible because it's inside of the unit trust.
Correct.
Now, if the unit trust didn't take on the debt and the individual took on the debt and then bought the units in that trust, the interest then on that debt becomes tax deductible because it's in the individual's name.
Correct.
And they then bought the units in the trust.
Correct.
Which then makes that interest deductible.
Correct. So the unit trust would have essentially no debt on the asset within inside of it because the individual has injected the money in via the purchase of units, and the individual now gets to claim that interest in their personal return because the financial instrument they've invested in is the actual units themselves. It is a way to do it.
Yeah.
It's a complicated way to do it, but it is doable, and I see it happen all the time. You just got to weigh up as an individual the cost versus benefit analysis.
Well, let's workshop it because I've seen it before. It's not very common because you need to have the capital outside of
to do it.
You can't obviously securitize it against the property in the unit trust and then have the debt outside of the unit trust. But what does that strategy look like for people?
Arguably, if let's say you've got $1.2 million of available equity. Now, talk about available equity because you might have $1.2 million of equity, but not all of it can be accessed due to leverages. But let's say you've got $1.2 million of available equity. You can then use and draw that out. There's an interest component and a bearing obligation on it. You then use that $1.2 million to purchase 1.2 million units. Now your unit trust has $1.2 million in there, which it then can use that money to go purchase an asset. The unit trust still claims its expenses, council rates, water rates, etc., but it's got no debt because it had this beautiful amount of unit money injected of 1.2 million. As the individual, you now get the distribution of the unit trust and you get to claim the expense, which is the interest that you have extracted from your own name. So in most circumstances, it kind of will even itself out in the wash.
Yeah.
It's when that unit trust may be, for argument, a very high growth property where there is absolutely zero income getting from it, which could be a land banking opportunity. Rather than carrying the losses forward in the unit trust, the individual's getting a large substantial amount of deductible debt in their own name. So a good example of doing that, you've bought a block of land for 1.2 mil in the unit trust using that same strategy I've suggested. You've extracted the equity out, used that to buy the units, which has then bought this block of land. There's no rental income on it. It's just all costs, council rates, water rates, insurances, etc. That means that that portion of small amount of loss on that block of land gets carried forward, but in the individual's tax return, he now gets to claim the interest. So that strategy works really well for non-income producing assets with inside a unit trust. When it's an income producing asset, it kind of comes out in the wash.
Right. And to get the 1.2 million out of an asset in your individual capacity, you'd need to have very strong servicing because it's coming out based on generating no income.
Correct.
So then you need to have very strong serviceability to put it then in the unit trust. And a lot of reason these days we see people wanting to invest via a trust is to protect that serviceability, and it would defeat that purpose as well.
Absolutely would. But it's actually a very doable strategy. I've used it and done it in the past, not often. It's got to be very rare circumstances and the right asset needs to be purchased. But most of the time there will be some benefit to the individual being able to claim that interest in their own name without having to carry forward huge amounts of loss caused by that interest. But in most cases you'll find that it comes out slightly in the wash in some circumstances.
What's another technical thing that you've worked on recently? I like the technical shit. The generic stuff that everyone does doesn't really interest me all that. But I like talking about things that are unique, and then when people hear them, they're like, fuck, that's really, really cool.
All right. So I manage a large number of high net wealth individuals. These are people that do have the opportunity and the ability to save up money, pay for deposits, and find generally positive geared investments. Not from day dot, because we spoke about it before, you make it happen. Now, investing in their own name when they're earning such high amount of income, that could be on high wages, or they could pay themselves high wages from their company, not through the endorsement of what I say to them. Obviously, I say, guys, live on less, but they don't. I like the strategy of being looking forward 10 years. These guys are buying income-producing assets, whether it's managed funds, shares, or property. Holding that in, their own names or arguably other things, terrible idea.
Yeah, because that just goes on to your taxable income, of which then gets taxed at your 47 cents
Correct.
a dollar.
So we're working with them to make sure that we're looking at the business plan of this property and what the outcome will be in 10 years or however long they want to hold it. We'll generally hold a lot of their assets, whether it is shares or property, inside trusts, rather than distributing it to them or to any of their other family members that could be on high tax rates as well. We're distributing it to corporate beneficiaries.
Like a bucket company.
A bucket company, and that is quarantining the tax obligation at 30%. Now, the plan is that we'll get access to that money sooner or later one day, and they're investing that money in that bucket company the way that they need to grow it.
Mm-hmm.
But once they do take some time off work, and these are people that will burn themselves out by the age of 55 and their brain will go to mush.
Yeah.
At that stage is when we'll start to release what they call dividends from that bucket company. And I'll be able to stream those dividends through to them and to their spouses at no more than the franking credit that's been built up, which is that 30% tax rate.
So just to explain to people, when you've paid the tax inside of the bucket company already at 30%, if you then distribute it out to someone as an individual, you will not pay extra tax unless they're on a higher tax bracket.
Correct.
So if they're on a lower tax bracket, you actually may get a tax credit.
Correct. So the accountants call it tax at the tail, and
Yep.
that's all otherwise known as top-up tax.
Mm-hmm.
If we as accountants can really strategically work with them to say, this is your plan that you want to not touch super, but you want to use this money by the age of 55,
Mm-hmm.
we'll strategically stream those dividends out to the beneficiaries, which are on now lesser tax rate. And what that ensures for these clients long-term is I've now given them the ability of obtaining a 17% return on their money through the reduction of tax that they haven't had to pay in that last 20 years of investing.
And what you mean by that is because they haven't paid 47 cents in the dollar, they've only paid 30 cents in the dollar, you're essentially guaranteeing yourself a minimum of 17%, even if you don't invest the money. It just sits there in cash.
Correct. And it's exciting because when you start to, it blows people's mind when you hear these numbers, but over 20 years, 1 mil, 2 mil, 3 mil, 4 mil is not off the cards, especially as they potentially might move money around. So, that's a lot of money. 17% of $1 million is 170 grand. Of $2 million, we're talking over 370,000 bucks.
I'd rather do my pocket than someone else's, that's for sure.
Absolutely. So it's about when you're devising a tax strategy, it's not looking at tomorrow or not looking at the next month or even 1 year. It's looking at the next 10 years. Mm-hmm. And that's what good accountants should be doing. It's
and just what really wealthy people do. That's the issue with the poor versus the rich, right? I understand there's different day-to-day challenges, but the difference is in the timeframes that they think in, right? Everyone today is thinking in days, weeks, and months, as opposed to, and this is this fucking regional shit. That's why I just don't believe in it, because if it was the right strategy, the richest people would do it. And if the richest people are not doing it, like I guarantee you're not seeing James Packer go, fuck, I might go buy a few $400,000, shitholes in fucking Darwin or something like that. And I understand we don't all want to be Justin, we don't all want to be James Packer. But I'd rather learn and emulate what these people do.
Follow the money. That's always the definition that anyone will tell you. You follow the money. And that's what the rich people are doing. You want to emulate it at a smaller scale, but not to defend those regional areas. But if you've got a good business plan around it where you can get in, get out and make some good money and move that into better performing assets or longer performing assets, you do it.
Agreed.
If there's opportunity.
Most people aren't at that level, though, aren't thinking about business plans.
Oh, yeah. But that's what cuts the line between the people that can be or are successful and the people that are not. You've got to be moving, and people that think property is passive and you get to sit on a chair and watch it all happen in front of you, more active you are with your portfolio, the better you'll be. And active doesn't necessarily mean digging holes and trenches. It could be going and painting it. The upkeep of your property. Make sure this is your asset, this is your business, and it's there to grow. Feed it. Like any business, you feed it and it grows. So your property portfolio, you feed it and it will grow.
Agreed. I saw something the other day. I can't remember. It was an accountant online, and there was a case that was recently won in court where same strategy that you just mentioned, bucket company, money was getting pushed out to that bucket company, 30% being a passive investment bucket company. And then they were pushing the money back into the trust. Did you see this?
Yeah, it's a UPE. It's called Unpaid Present Entitlement.
And then they were trying to get them on Div 7A.
Yeah.
And they won the case of not then having to pay Div 7A, which could mean huge refunds for...
That's it. It's UPE, unpaid entitlement. Right. So it's essentially the asset is in the trust. It distributes the profit to the bucket company, but the money doesn't move across. That money stays inside the trust to pay down the debt, but being disclosed in the company. There's a lot of back-end paperwork behind it to recognise what a UPE is. I strongly advise people that you talk to your accountant. Your circumstances will dictate whether you can or can't do it. But it's been a fight with the ATO, and I know a lot of large accounting firms use this particular strategy to pay down large amounts of debt while getting substantial amount of tax benefit, because where possible, we always want to try to have assets in a trust environment for the 50% discount.
CGT, yeah,
where
yeah.
within a company, we don't get that. Yes, we get a lower tax rate on earnings at 30% compared to our own name at, say, 47 or 25% if you're a trading company. So that's always been the bargain bear of all accountants. How can I still pay down this asset with the cash, but use the company's money that I've distributed it to facilitate?
So essentially what they were doing originally was comes into the trust, push it out to the holding company, and then bring it back to the trust to pay down the debt.
Correct.
Right.
And in normal environment, that would be considered Div 7A.
That's right, because you're loaning it back to the trust.
Correct.
Yeah.
And there's non-deductible interest involved in it and repayments over 7 years. But it is doable. You need to make sure that you are speaking with your accountant to get proper written advice, because there's a lot of parameters around it. And if it goes wrong, it can be very costly.
Well, how did this case happen? Did you know the case I'm talking about?
I know the case
I heard the guy talking about it. I was like, fuck, that's very interesting.
Yeah, the proper UPE documentation was done. It
Right.
was strategized. A tax office wanted to bring it in as part of the ruling of Div 7A with Inside Trust. That's recently been brought in probably 5, 6, 7 years ago. More brought to light. But he's been doing this for a number of years, well before that. So that's how they kind of won the case, with the right documentation, and there's history of it over a long time of doing it.
Interesting. So that's another thing. Let's touch on that as well. Div 7A. I see a lot of company owners thinking they can just rip money out of their business, pay for a big owner-occupier mortgage, pay for lifestyle expenses, thinking that they don't ever have to pay that money back. High level, what is Div 7A for business owners?
Drawings. So
Right.
if you're a director or an employee of a company, or you're both, you're drawing money out of your company without declaring it as a wage or a dividend, then it would be considered Div 7A, which means that you're taking money out of your company under a loan arrangement where you agree to pay the money back within 7 years, principal and interest. The company will pay tax on that interest, but you don't get to deduct the interest that you've paid to the company as a deduction in your own name. So it's a nasty way of giving the ATO more money in terms of tax revenue through the interest you now need to pay back the company.
But the reason people do it is because they avoid the tax in the short term.
They avoid the tax in the short term. What I do see a lot of people do is they might have a huge amount of retained earnings in their company. They will then loan that to another company. And that other company will then use that to buy other investments. So there's no Div 7A issues between company to company. What they're doing is they're utilising a large amount of capital in retained earnings where the tax in effect was only 25% as opposed to 47%. So it's giving them now more capital in another company to be able to invest more money. Only issue is there's no capital gain tax deduction inside a company. So the tax at the tail, and you heard me say that before, that's the top-up tax you pay when you eventually want to get that money out of the company.
Which is the tax between what the company's paid it out and what you have to pay it as an individual.
Correct. If you're not making a strategy for that, to dividend stream that later on in the future under the right conditions, then that tail tax can be a hell of a lot more than what the capital gain discounted tax rate would have been, which would have been worst case 23.5%. So it can work really well to acquire assets. If you don't sell them, you're not going to have to worry about tax at the tail.
Yeah.
The next generation will. So that's a positive. But if you are going to sell them in the future, you just need to be mindful that top-up tax, again, that difference between company and your marginal rate, you've got a plan and a strategy to stream that out of the company. So at worst case, you're not paying any further than 30% tax.
That's exactly what we did with the recent wedding venue purchase. Retained earnings in the company, we loan it to another company that then bought the venue. That'll lose money for a while, and then eventually as it starts to become profitable, we'll pay the income back to the
perfect. And very common way to do it, and the very common way that the rich do it, because as we all know, the rich try not to sell too much. The way that they generate their level of cash flow is always drawing upon the banks. I was just reading a great story again, how Elon Musk shares how he doesn't pay a huge amount of tax, pays a lot,
12 billion individually, the largest taxpayer in history.
But he could definitely be paying a hell of a lot more, because he takes a loan against his shares. As those shares go up in value, he'll get to take a loan against it, and it's tax-free money that he's using. So it's not a secret. The rich pretty much tell you they do it every day.
Use debt.
They use debt. And
tax-deductible debt.
As the property grows, they get to take a little bit more cash out, and that may fund their lifestyle or fund other things they want to do.
And ideally, you're investing it and still generating cash flow as well, so it all balances out.
Hopefully.
Mate, finalising words. We're bang on time here. What's in store for 2025? I mean, we're end of Q1 in, 10 days. fucking wild, isn't it?
Yeah, look, definitely there's
Or
a
Q1 this year, Q3 financial year.
yeah. Well, I always talk my year ends in June, starts in July, but Q1 for the people that work on calendar years,
Yeah.
I'm definitely seeing a flurry back to the market.
Mm-hmm.
I've seen confidence come back into my client base, and I manage a huge amount of investors that own thousands of properties, and I'm going to say billions of dollars of value.
Mm-hmm.
So I get to see a large demographic of very successful investors, what they're doing. The confidence is back. The rhetoric around further reduction of interest rates is really prompting that confidence. So we will see, I think, in my opinion, a strengthening, especially here in the New South Wales market. A lot of the hotspots may, the lower end of the hotspots may lose a little bit of their heat as potentially a lot of these East Coast investors come back and invest in their own state. Could be upsizing, downsizing, more investment properties, units. I'm starting to see have a lot more prospect. More and more people, especially here in New South Wales, are turning up to units because, again, that disparity between what a unit's worth and what a house is worth is just grown so much. So a lot more confidence in the market. Definitely seen a huge amount of activity, more than what the media are suggesting in Victoria. The media aren't showing you videos yet, but there are 40, 50, 60 people turning up, especially in those first home buyer, owner-occupied areas, to that open home. And the media's not showing you that. So definitely we're going to see a huge topic, a huge strengthening off the back of that in the Victorian market. I think people just need to be aware that it may not move at leaps and bounds at 30%, but that is a market traditionally which should be much closer to New South Wales.
The highest performing marketplace up until, I think it was end of 2021, start of 2022, is the strongest performing market in Australia over the last 25 years.
It will find its place.
And it just had the largest sale price in all of Australia. It beat fucking Point Piper.
Hang on, 80 mil?
150.
150, there you go. So it will find its place again where it needs to be, behind New South Wales. Always Victoria's behind New South Wales, but it will find its place, and it will start to overtake a lot of these states which have done incredibly well. The run that they've had over the last 4 years is amazing.
Adelaide, Perth.
Huge. And these are places that for 10 years, especially you look at Adelaide itself, if you annualise the growth over 20 years, it comes...
It's terrible. We do it all the time.
But the last 4 or 5 years...
It's cranked.
Wow.
Yeah.
And I've seen people make so much money there. And
such a funny place, Adelaide. You drive literally 25 minutes out of the city and it's like a fucking desert.
Again, for statistics for people, I think Adelaide, last time I checked, had roughly just over 2 million people living in South Australia.
Yeah.
Of which about 1.6 million people live in Adelaide itself. So again, very small population in terms of land mass, but very concentrated.
It's a very pretty place.
Beautiful place.
I ran an ultramarathon there last year in the Flinders Ranges. So I've been to Adelaide plenty of times, never been out of the city. So we got the motorhome out, we drove out the freeway. Literally 25 minutes. I'm like, it's fucking red dust here.
Yeah,
and then you get an hour out. And mate, she's bare bones. There's not much out there.
It is. Again, 1.6 million or just there and above live in Adelaide itself. So, but it had a wow of a run for the 4 years.
Wild. Yeah.
I've personally got properties and commercial properties in Adelaide itself, and I love commercial properties in Adelaide. No stamp duty.
And stamp duty.
Love that. I hate paying stamp duty. I should get a certificate from New South Wales State Government for all the stamp duty I've paid over the years, but it's done really well. WA, we know, has done really well, though maybe I believe tapering off. Victoria is its opportunity to now buck the trend,
flurry,
and it will have its time to shine as it allowed all the other states to really overtake it over those years. New South Wales will always continue to do well, and it will always be the benefactor of a large portion of interstate migration and overseas migration. That's just the way it's always going to be. And Queensland, it's definitely off its high, no doubt about it.
Yeah.
But what I am seeing is people there that are buying are looking to buy better quality properties.
It's still ticking, like Brisbane's still ticking along. It's not cheaper now than it was 12 months ago.
No, it's had the best price movement it's had for a very, very long time.
And you can see the city changing, a lot more money there, people spending a lot more money on owner-occupier homes.
A lot of wealth's moved there.
Huge.
And as wealth moves into these regions, it brings up the economic status of that region substantially. And I know firsthand a lot of wealthy people have moved for that lifestyle.
Brisbane and Goldie.
Absolutely. And Gold Coast has been a benefactor
Goldie's
of
cranking.
A lot of New South Wales wealth.
Yeah. By the beach. Mate, that was awesome.
Thank you.
Also, for podcast listeners, one of the bits of feedback I get all the time is Jack bangs the table time like this and people hate it. So we got these fancy new mics now, which should stop that. So please let me know if I I cut back on the hitting on the desk, but mate, I appreciate your time.
Always a pleasure.
Thanks, legend.
This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production.